Good evening, everyone. My name is Paul Young. I'm just going to walk you through merchandise trade for Canada for the month of February 2016. Typically, with these trade stats come out, they're laggard indicators, which typically means they're usually about a couple of months behind. So the indication of what happens is you don't necessarily see the rate benefits right away, so that's why sometimes the data is misleading. Now, this presentation is one opinion of the analysis. It's not the only opinion. You're more apt to go out and listen to what the various banks say from TD, CIBC, Royal Bank, Bank of Nova Scotia, even the government sites to see what the stats say. A little bit about myself. I'm a CPA, CGA by trade. I've got a background in academia, industry, as well as financial solutions. Now I'm going to talk about the overall trade. I'll talk about the trade imbalance. I'll talk about some key sectors as well. Now, you have to look at trade in multiple angles here. First of all, February is typically a short month. There's less days, so you have to factor that into play. But you also have to factor in certain things in play too. The currency itself, the dollar is going to drive some of the exports, so the absolute dollar value may be different from year over year because of the currency change. So you have to look at volume. So what it's basically saying here, that in terms of real volume, we're basically about 2.2% down from the previous month. Okay, that's down, but it's not a big number to be down by, and that's something to bear in mind. Okay, second thing is we had a very strong January for trade. So maybe companies were building up some of their inventory as part of the initial phase of the first quarter. And possibly what's happening, there's been some clawback in February. So that's why you need to take things with a grain of salt. Now, like anything else, there's key sectors that you're going to look at here. So what I've done with this particular chart is I've looked at the average for 2016 and compared it for the average of all 2015 to get a run rate. So in essence, what I'm seeing, despite all the doom and gloom, I'm saying is the first 2 months are actually done significantly better than we did all of last year. Now if we peel back things and kind of look at a high level view of seeing what the change is, we're seeing a multitude of things happening here. Okay, energy products pricing was a bit better the same period last year. So that's having the influence on some of the value. So that's why you're seeing energy products are down almost $2 billion. But what you're seeing is we've had a strong automotive sector, which has grown by 1.7 billion, as well as some other sectors like forestry, machinery, and all that. So we've almost offset the drop in oil through stronger sectors in manufacturing, which is basically automotive, food processing, forestry, consumer goods. Now, consumer goods are everything that we produce, like furniture here. We produce drugs. We produce different products that are still made here in Canada. This doesn't mean everything from China is there, but we do make a certain amount of consumer products here. And the low Canadian dollar actually helps those consumer goods and makes them more attractive in pricing. Trade imbalance is another area that you need to look at. And what you're really seeing here, the biggest difference is, look at the trade imbalance between Canada and the US. It shrunk. So that's part of leading to a higher thing, but look at what you're seeing with other countries. We haven't closed that gap down. So government policies come into play here. Now, in fairness to the Liberal government of Canada, they've only been in power since November, so they can't be responsible for any terms of export stuff because trade deals haven't kicked in. That being said, the Conservative government cannot take all responsibility for a strong economy or exports being down. What you have to look at is the economic growth. Worldwide, we're in slow economic growth, especially in Europe. So if Europe doesn't need our exports, then that's a problem. And that's what you're seeing here as well. So you need to bear in mind, you look at China, we haven't closed that gap with China. That's something that the new government has to kind of look at, because all we have is a FIPA deal with them. We have to look at how we can expand exports into China. And that being said, China is actually going to experience low growth. Energy sector is key here. And I threw this chart up here for a couple of reasons. Since February 2015 to now, the price of a barrel of oil has dropped by 40%. Natural gas has dropped by 40%. So it only makes sense on the correlation that you see oil rigs down about in relation to that. If oil rigs down, that means we're not pumping as much oil. That means our exports are down on volume level, and that's something to bear in mind. So the oil sector is at the lowest level since 2003. But that means also other sectors have picked up some of the offset. Automotive had a banner year in 2015. Banner year. We're now seeing a clawback now to reasonable expectations of what we may see happen this year. That we may see the units go from about 17.1 million to maybe in general 18.1 million. There's a wide string of about 1 million units right now. It's hard to tell what it is, but there could be some clawback in automotive. That impacts automotive in Canada. Second point is we haven't seen huge investment in Canada lately to expand capacity here. We've seen some aspects of it, but there hasn't been new plants built, so that's coming into play right now. So the existing capacity is probably about all we could do here. So we may not see any more additional automotive production in Canada in terms of exports because the capacity is not here. This is consumer products. This is price sensitive area, but it's also come into play that it benefits anybody in the food processing area, maybe in some of the clothing area, furniture, because now there's a stronger U.S. economy. We've got low dollars, so our pricing may be able to help. It's something in the area that we should watch out for as we move forward. Forestry, we've got two things in play here that are going to impact these numbers. One is we still see significant housing starts. They're down a little bit from where we saw a peak in December. So they're marginally up a little bit in February. That's going to drive things. But the other policy change that's going to be driving it is the softwood lumber deals coming into play in the negotiation. That's going to impact forestry exports. Aerospace is in a bit of a cycle here in Canada. There's some significant issues what's going to happen with Bombardier on the CS series planes. That's something you need to watch. But in February's case, we saw a good potential with aircraft in terms of parts and engines and stuff like that to benefit some replacement aircrafts in the U.S. That's a sector to watch. Now in transportation in general, there's a couple things that are some banner areas. We're seeing municipalities, cities across the U.S. and Canada investing in infrastructure for transportation. That means rail cars, it means buses. We're seeing companies like New Flyer Industries out of Manitoba benefiting from that, so there's uptick in that. We're seeing areas in terms of metal fabrication areas where we're seeing certain aspects around infrastructure building on roads and stuff that we may see come into play as well. The defense contracts coming into play too as well as they ramp up in Nova Scotia, so that should be an uptick. Again, it may see a bit of a clawback depending on the government's commitment to spend in that area. Food processing, as I talked earlier about it, is another key area that you need to watch out for. What's happening is it's still driven. People need to eat, so we'll probably see some of that come into play. So what am I saying here in general? Okay, we've yet to see the budget numbers facilitate into the GDP in terms of supporting exports. It's something that you need to watch out for as you move forward in terms of assessing the economy. Like anything else, February gave back what January took. So if you even the numbers out, we're still in significant good position. Retail sales have shown strong improvement, so we're still in relatively good shape. So we should still see a decent quarter, even though despite we've had a little rocky start in February, the exports and overall and trade has been significantly good this so far this year compared to where we were the same period last year, where we were in a bit of a recession. That's something to bear in mind. So as you look at the numbers, try to peel back, but also don't get too fixated on government policies, because government itself can't take full responsibility for a growing economy, especially in the trade area. It can't take 100% fault when it's shrinking. But the government itself has to look at policies, and that's where this is coming into play. One of the things that it said in here in part of the trade is the imports are down. Part of what you're seeing happen is that we are shipping oil across Canada by rail. One of the key drivers here is what we do in terms of our infrastructure investment to move exports to market. Exports are undervalued by 25%. If we were to grow that business by 25%, an extra $100 billion worth of exports, that would generate at least $500,000 more jobs. And that's significant. That means those jobs are good paying, they're actually feeding income in. And that's something to bear in mind too as well as you assess government policies. The other area that comes into play that impacts too is internal trade barriers. We need to break them down to help the internal economy prosper. So as we're looking at things, we need to bear that in mind as we do analysis. my question to everybody is, as you go out there, don't take one opinion assessing the exports. Take the opinion of a multitude of people to assess the situation. There's too many times in mainstream media that they'll make an opinion out there, but a lot of cases it's not necessarily factual. It's designed for a purpose. Remember what media is doing. They're trying to sell readership. They're going to do certain things to sell readership. That being said, you have to factor that into the equation. Thank you.